In the first quarter of 2025, the U.S. economy contracted by 0.5%, marking the first shrinkage in 3 years and reversing a 2.4% growth in the previous quarter, according to the Commerce Department. This sharper-than-expected decline, initially estimated at 0.2%, was largely driven by a 37.9% surge in imports as businesses and consumers rushed to purchase foreign goods ahead of anticipated tariffs from President Donald Trump's trade policies. This surge in imports significantly impacted the GDP, dragging it down by nearly 4.7 percentage points. Consumer spending, a key economic driver, also decelerated sharply, growing only 0.5% compared to 4% in the last quarter of 2024. Reflecting consumer apprehension about the impending tariffs. The contraction has affected consumer sentiment, with the Conference Board's Consumer Confidence Index falling to 93 in June, its lowest since the COVID-19 pandemic, indicating potential economic challenges. Additionally, federal government spending decreased by 4.6%, the largest reduction since 2022. Despite these setbacks, the underlying economic strength, excluding volatile items like exports and inventories, showed a 1.9% annual growth rate, suggesting some resilience in business investment and private sector activity, particularly in durable goods orders, which rose by 16.4%. Economists remain cautiously optimistic about a rebound in the second quarter, projecting a 3% growth rate, as the import surge is not expected to persist. The labor market presents mixed signals, with a rise in jobless claims, but Federal Reserve officials, including San Francisco Fed President Mary Daly, do not see this as indicative of a weakening labor market. The first estimate for April to June GDP growth, anticipated on July 30th, will provide further insights into the economic trajectory, with the Federal Reserve closely monitoring inflation and labor market dynamics for future policy adjustments.
Hims & Hers Health, Inc., NYSE, HIMS, a telehealth company known for providing online consultations and wellness products, is under investigation by the securities law firm Blakemar, Fonte & Ald LLP for potential violations of federal securities laws. The investigation follows a significant development where Novo Nordisk terminated its collaboration with Hims & Hers, citing deceptive marketing practices and the illegal sale of counterfeit versions of its weight loss drug, Wegovy. This announcement led to a substantial 34% drop in Hims & Hers stock price, from $64.22 to $41.97 per share, highlighting investor concerns over the company's business practices and future prospects. The termination of the partnership with Novo Nordisk and the subsequent legal investigation could have far-reaching implications for Hims & Hers. The allegations of selling illegitimate products not only damage the company's reputation, but also raise potential legal and financial liabilities. Investors and stakeholders are advised to monitor the situation closely, as the outcome of the investigation and any resulting legal actions could significantly impact the company's financial health and market position. Shareholders are encouraged to explore legal options, with Blakemar, Fonte & Ald offering representation on a contingency fee basis, indicating that investors may have recourse to recover potential losses incurred from the stock's decline.
The European Union (EU) is contemplating strengthening its economic ties with China amid strained relations with the United States under Donald Trump's second administration. The EU, feeling sidelined by Trump's aggressive trade policies and geopolitical maneuvers, is exploring a more autonomous approach by potentially deepening its partnership with China. This comes as China, embroiled in its own trade tensions with the U.S., sees an opportunity to strengthen its ties with Europe, aiming to mitigate the impact of U.S. tariffs and maintain its economic influence. The upcoming EU-China summit in July, marking 50 years of diplomatic relations, could signal a shift in global alliances, with both parties keen on stabilizing their substantial trade relationship, which amounts to approximately €2.3 billion daily. However, the path to deeper EU-China cooperation is fraught with challenges, including Europe's significant trade deficit with China and concerns over China's human rights record, espionage activities, and its stance on the Russia-Ukraine conflict. The EU is wary of becoming overly dependent on China, especially in critical sectors like minerals used in manufacturing. Despite these challenges, China is likely to push the EU to lift tariffs on Chinese electric vehicles and reconsider the Comprehensive Agreement on Investment, Such moves would not only signal a shift in EU-China relations, but also send a strong message to Washington. As Europe navigates this complex geopolitical landscape, it must balance its economic interests with strategic autonomy, all while managing its long-standing alliance with the U.S.
The U.S. dollar is experiencing significant pressure, hitting its lowest levels in over 3 years against other major currencies, as concerns about the independence of the Federal Reserve intensify. President Donald Trump's recent criticisms of Fed Chair Jerome Powell, coupled with hints at potential replacements, have fueled investor anxiety. This apprehension is compounded by the expectation of interest rate cuts and a looming deadline for trade agreements. The dollar has depreciated by 10% this year, marking its worst performance since 2003. Investors, wary of potential political interference in monetary policy, are increasingly shorting the dollar. Anticipating further declines, the uncertainty surrounding the Fed's leadership and policy direction has broader implications for global markets. The European Central Bank has urged regional lenders to evaluate their dollar needs amid fears they might not access the Fed's resources under the current U.S. administration. Additionally, a survey by OMFIF revealed that 70% of central bank reserve managers are deterred from investing in the dollar due to the U.S. political climate, a significant increase from last year. This erosion of confidence in the dollar's safe haven status could lead to increased volatility in currency markets as investors seek stability in other assets.
Former Barclays CEO Jes Staley has lost his legal challenge against the Financial Conduct Authority, FCA, in the UK, which upheld his ban from the financial services industry due to his misleading statements about his relationship with the late financier Jeffrey Epstein. The London court's decision effectively ends Staley's efforts to restore his standing in the British financial sector. The FCA argued that Staley's ties with Epstein, which included visits to Epstein's private island and introductions to influential individuals, were more than professional, suggesting a deeper relationship that compromised his integrity. Consequently, Staley's fine was reduced from £1.8 million to £1.1 million, reflecting his forfeiture of share awards following the FCA's disciplinary actions. The ruling underscores the FCA's stringent standards for integrity among top executives in the financial industry, highlighting the repercussions of failing to maintain ethical conduct. The case has not only impacted Staley's career, leading to his resignation from Barclays, but also brought attention to the broader implications for financial institutions in managing reputational risks associated with their executives' personal associations. The outcome serves as a cautionary tale for industry leaders about the importance of transparency and ethical behavior, particularly in light of heightened regulatory scrutiny and public expectations. Staley has 14 days to appeal the decision, but the ruling marks a significant moment in the FCA's enforcement history, emphasizing the critical role of integrity in financial leadership.
President Donald Trump is considering extending the deadlines for imposing steep tariffs on imports from the European Union and other countries, according to recent White House statements. Initially, Trump had set a July 8 and 9 deadline to reimpose tariffs, including a potential 50% duty on EU imports. However, White House Press Secretary Caroline Leavitt indicated that these deadlines are not critical, suggesting flexibility in negotiations. The tariffs, initially paused in April, were meant to pressure countries into negotiating trade deals, with the U.S. having secured only 2 preliminary agreements with China and the UK so far. The potential extension of tariff deadlines has positively influenced market sentiment, with stocks rising following the announcement. This development is crucial for global trade dynamics, as it alleviates immediate pressure on international markets and provides additional time for trade negotiations. The possibility of extending tariff deadlines is aligned with Treasury Secretary Scott Bessent's earlier remarks that such an extension was highly likely. As the U.S. continues to seek trade agreements, particularly with India, the administration's approach reflects a strategic maneuver to balance domestic economic goals with international trade relationships.
The latest labor market data indicates a mixed picture for the U.S. economy, with initial jobless claims decreasing slightly from 246,000 to 236,000, defying expectations of 243,500. However, continuing jobless claims have risen to 1.974 million, marking the highest level since November 2021. This increase suggests that while fewer people are initially filing for unemployment benefits, a larger number are remaining on unemployment rolls for extended periods. This trend could signal potential challenges in the labor market, where displaced workers might be facing difficulties in securing new employment. The data, sourced from Bloomberg, highlights regional disparities, particularly in the deep tri-state area where jobless claims continue to rise. This regional uptick could reflect localized economic pressures or industry-specific challenges. The mention of delayed DOGE effects is ambiguous but may refer to broader market or economic disruptions influencing employment trends. The persistence of high continuing claims could impact consumer spending and economic growth, as prolonged unemployment typically leads to reduced household income and spending capacity, affecting overall market sentiment and economic stability.
NVIDIA, Nasdaq, NVDA has reached new highs, continuing its upward trajectory as a leader in the semiconductor industry, driven by robust demand for its AI and data center products. In contrast, Tesla, Nasdaq TSLA, has experienced a pullback, reflecting investor concerns over production costs and competitive pressures in the electric vehicle market. Meanwhile, Celestica, TSX-CLS, shows promise with strong performance metrics, suggesting potential growth in the electronics manufacturing sector. The broader market sentiment remains optimistic, with the VIX, an index measuring market volatility, indicating stability and supporting higher stock prices. The Nasdaq has successfully broken through resistance levels, while the S&P 500 and TSX exhibit bullish trends, suggesting a seasonally favorable period for equities. Commodities such as gold, silver, crude oil, and natural gas are also seeing impactful movements, influenced by global economic conditions and energy sector trends. This environment presents investors with opportunities to make strategic decisions, considering the dynamic interplay of market signals, economic reports, and sector-specific developments.
The current debate in Congress over the child tax credit is a significant financial event, with both the House and Senate proposing increases in the credit amount as part of the budget reconciliation bill. The House version suggests raising the credit to $2,500 per child, while the Senate proposes a $2,200 cap. This credit, which is partially refundable, aims to provide financial relief to families with children under 17. However, the benefits distribution is contentious, as an estimated 17 million children would not qualify for the full benefit due to income restrictions and the non-refundability of the credit. The implications of these proposals are substantial for family finances and economic policy. The House's plan, which extends the higher credit until 2028, could offer more prolonged financial support to middle-income families, potentially influencing consumer spending. However, the limitation on refundability means lower-income families may not see the full benefit, as those earning less than $2,500 annually cannot claim any portion of the credit. The ongoing legislative negotiations and the requirement for children to have Social Security numbers further complicate the bill's potential impact, with the House's additional requirement for both parents to have Social Security numbers potentially excluding more families from the benefit. The outcome of this legislative process will be crucial in shaping the economic landscape for millions of American families in the coming years.
Clarios has unveiled plans to establish a manufacturing technology and training center in the United States, a strategic move within its broader $6 billion American Energy Manufacturing Initiative. The facility is designed to be a hub for workforce development and manufacturing R&D, focusing on advanced technologies such as robotics, AI-augmented systems, and autonomous material handling. This aligns with Clarios' goal to enhance productivity, quality, and safety in its battery production network, which plays a crucial role in supporting U.S. mobility and energy storage sectors. The center's development underscores Clarios' commitment to reshoring manufacturing capabilities capabilities and strengthening U.S. competitiveness in the global market. This investment is part of Clario's strategy to revitalize American manufacturing, supported by recent federal incentives like advanced manufacturing tax credits. The center will also serve as a national hub for upskilling the workforce, offering training programs and workshops to prepare employees for the evolving manufacturing landscape. By focusing on cutting-edge R&D and hands-on training, Clarios aims to create a more efficient and skilled workforce, thereby enhancing its operational efficiency and safety performance. The company is currently evaluating potential locations for the center, with plans to announce the site by the end of the year, potentially leveraging public-private partnerships and existing workforce initiatives.